Imagine you're responsible for hundreds of millions of dollars, not your own money, but capital belonging to clients, pension funds, or institutions. Your job isn't to chase moonshots. Your job is to protect that capital and generate steady returns. Now imagine that part of that money is sitting in crypto, earning a few extra percentage points through DeFi compared to a traditional bank or treasury yields. That's the real reason institutional money entered crypto in the first place. Not ideology, not decentralization, but yield. Stablecoins get wired in, converted, deployed on-chain, and used in lending or structured strategies. As long as the system looks safe enough, that trade-off makes sense. But institutional capital doesn't think like retail investors do. Retail can say, let's see what happens. Institutions can't. The moment a risk appears that can't be clearly priced or timed, everything changes. This is where quantum computing enters the picture. Quantum computing is no longer science fiction or something that might happen far in the future. Governments, defense agencies, and the largest technology companies in the world are investing heavily in it. When you look at multiple roadmaps across the industry, they all start to point toward the same window. Somewhere around the end of this decade, current cryptography may no longer be safe. And if modern cryptography fails, this isn't a small problem. It's not a temporary dip in price. It's a systemic issue. If private keys can be derived from public keys, ownership on blockchains breaks. Wallets, smart contracts, and the core security model collapse. That's not a partial loss scenario. That's close to total failure. Now put yourself back in the position of an institutional allocator. Your earning may be 3 or 4% more on-chain than you would in traditional markets. But in exchange, you're exposed to a risk that is hard to predict and impossible to insure against. No one knows exactly when it happens. It could be 10 years away, or it could arrive much sooner than expected. Institutions don't wait for certainty. They don't need a guaranteed disaster. A small probability of a catastrophic outcome is enough. An extra few percent in yield doesn't justify even a low chance of 100% loss. So, the decision becomes simple. You don't debate it. You don't wait and see. You exit. This is why institutional money behaves very differently from retail. The moment quantum risk moves from theoretical to plausible, capital starts leaving the chain. Not slowly, not emotionally, but decisively. Meanwhile, the traditional financial system is already preparing. Banks, payment networks, and even web browsers are actively moving toward post-quantum security standards. They have centralized control, clear accountability, and the ability to upgrade quickly. Blockchain doesn't have that advantage. Changes require coordination, governance, consensus, and time. And if post-quantum readiness doesn't arrive fast enough, institutions won't sit around hoping for the best. They'll move funds back off-chain into quantum-safe bank accounts and wait. This creates a powerful dynamic inside crypto itself. If one blockchain can convincingly demonstrate a real path toward post-quantum security before the others, liquidity won't hesitate. It will move there immediately. Institutions are not loyal to Ethereum, Solana, or any specific network. They're loyal to risk management. And if no blockchain is ready, the outcome is even simpler. The money doesn't rotate to another chain. It leaves the entire crypto ecosystem. That's why post-quantum security isn't a niche technical discussion or something to worry about later. It may be the single most important strategic issue for crypto over the next few years. Markets today are largely pricing in the assumption that this risk is either too far away or irrelevant. But institutional capital doesn't operate on assumptions. It operates on probabilities. And the moment that probability is no longer close to zero, the exit starts.